So hi guys, welcome back. Today we're going to be looking at Upstart Holdings. It's an AI lending platform that partners with banks and credit unions to provide consumer loans using non-traditional variables such as education, employment to predict creditworthiness. So what this means is they use AI and machine learning to see how worthy someone is to take out a loan, how much interest they should pay, and they partner with banks to make it a more seamless transaction and better both for the customer and the bank. So because they benefit both parties in this, I believe this is a very interesting company to look at. It has grown tremendously over the last 8 years. Its revenue last year was close to $234 million. It is up more than 400% year to date, more than 1,100% since its IPO. And I believe it has a fantastic growth story, and the fact that it uses AI and machine learning could make it infinitely more valuable to both consumers and banks in the financial sector. We're seeing a lot of fintech companies pop up, and I believe this is one of the more promising ones. So today we're going to be doing a stock analysis on Upstart. If you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we're going to be looking at is the Upstart Investor Relations page. As I mentioned previously, they are an artificial intelligence lending platform that uses sophisticated machine learning models to accurately identify risk and approve more applicants rather than the traditional credit score based lending models. The next thing we're going to be looking at is a NASDAQ article and this graph at the bottom where it talks about analyst reviews. So analysts have given Upstart a 10 out of 10 and they have rated it as an outperform. All 7 analysts have rated it as a strong buy with an average target price of $189. Note that is quite a bit lower than where the stock price is trading right now, about $219, $220. But the fact that it was a unanimous consensus of a strong buy is still a very good sign. The tips rank investors show that sentiment as a whole is very positive to the stock. It was up 2.9% over the last 7 days and 33.4% over the last month. Blogger opinions and outside of the traditional investors, overall the average investor is still very bullish. It has an Upstart sentiment of 100% compared to the sector average of 70%. The news sentiment is also very bullish. It is 100% bullish news and 0% bearish news. And insider activity is that people inside the company have been buying shares worth close to $43,000 over the last 3 months. So as a whole, this has showed that people are have a very positive sentiment to this stock, and that could go in a long way about how that stock performs in the short term. And of course, with that growth would come long-term performance there as well. So the current way that people rank people who are trying to take credit loans is through the FICO score, which was invented in 1989. And this is used in 95 of the largest 100 financial institutions in the world and half of the top 100 banks in the world as well. However, Upstart believes that this system is outdated and inefficient. Upstart traditionally focuses on personal loans. It's an industry which is worth $84 billion in the United States alone. However, it has expanded into auto loans, which is a $635 billion opportunity to its market that it can control. However, over $4.2 trillion in consumer loans are originated each year in the US, and Upstart plans to grow its business across new loan factors and other branches in the financial system over time. So overall, the company does have a very tremendous market opportunity. So to end this outdated and inefficient system, the platform leans on big data and artificial intelligence to provide lenders with a more modern solution. As a result, banks benefit from greater approval rates, lower fraud and loss rates, and a highly automated lending process, and consumers benefit with greater access to credit, lower interest rates, because they aren't subsidizing borrowers who default. So as a whole, this benefits both the consumer and the lender or the provider, in this case the bank. And because it benefits both parties, I believe it has a very good place in the market. If it can benefit both parties in personal loans, there's no doubt it could help it in the auto loans and of course the big $4.2 trillion in consumer loans there as well. So the market opportunity is amazing, and the way they have been able to benefit both parties is also very, very promising for this company. It also has a very strong competitive position. It collects 1,600 details per applicant, which is way more than the 10 to 20 variables considered by the traditional FICO or FICO scorecard. It trains data against 10.5 million repayment events, and it creates AI models to precisely quantify the risk. During the COVID-19 pandemic, Upstart's AI models were 5 times more predictive than the traditional current used, such as the FICO scorecard. And the Consumer Financial Protection Bureau shows that Upstart's technologies boosts approval rates by 27%, while lowering the average interest rate by 16% as well. So banks are getting more customers, and the customers are getting their loans for cheaper prices and lower interest. So that is a very big win-win scenario in this market. As more and more loans are originated through the Upstart platform, the company collects more repayment data, which means that its AI models will be more accurate. And as the models become more accurate and more intelligent, its lending partners can approve more loans at lower and lower rates, which should bring even more applicants to the platform, which brings in more data, which brings in a better model, which brings in more loans and more lending partners, more applicants, more data. And this kind of basically creates a snowball effect. And eventually you can see how this company can quickly take control of the market very fast and very efficiently. So next we're going to be looking at this Seeking Alpha article about 3 catalysts that could send Upstart to new highs. So first, Upstart is expanding its horizons. For the company in June facilitated more than 100,000 loans for the first time in history, and its approval loan value surpassed $1 billion. This is a record performance, and this is on top of the increasing popularity of Upstart's AI-based lending platform for personal loans. The company is also aggressively diversifying into the auto loan sector, which is a very strong driver in earnings into the future. You saw previously it was about a $635 billion market that they're tapping into. On top of this, they expanded its auto loan origination platform into 14 new states, and the service is now available in 47 states, covering approximately 95% of the US population. It increased its dealership footprint by 24% compared to Q1, and the 5 banking partners that have already signed up to auto loans as Upstart customers already. So data is a key ingredient to Upstart's success, and we'd see over the next 12 months, Upstart will gather more and more data. As I mentioned, currently they have 95% of the US population covered, and the company can use this to improve its auto lending algorithm the same way that it did to its personal loan segment. And if that works well, we would see it diversifying into the consumer loans, which is a 4.2 trillion market there as well. Upstart generates the bulk of its revenue through fees collected from partnering banks, and it acts as a middleman in facilitating transactions. For the second quarter, fees from banks accounted for 97% of the revenue, which goes to highlight that Upstart shareholders are not exposed to any credit risk whatsoever. If you are invested in shares of a bank or a traditional financial services company that keeps loans in their balance sheet, you would naturally be exposed to credit risk, but investing into Upstart does not. So it does offer investors a unique way to invest into the financial service industry without taking on credit risk, and the company has shown how efficiently its business model can run. However, because it acts as a middleman, there is a risk that comes with this. If banks start to invest into their own AI models and start to create it for themselves, it is possible that Upstart will be ruled out or their revenue will fall a lot further. However, because Upstart will be working with many banks and many customers, it is also much more likely that their own AI models will be more effective, and therefore it will keep them in the game. In this way, it could go either way, but right now I'm leaning towards the side that because of Upstart having more customers, its AI model will be more efficient than, let's say, if a bank tries to do it itself. However, because Upstart hasn't got the breadth of customers that, let's say, JP Morgan has, or let's say JP Morgan and a few other banks try to create an AI model within themselves, because Upstart isn't that big, it would have quite a lot of risks currently as a smaller company, but as we see this company grow into the future, I'm pretty sure those risks would subside, and then we would see once again the benefits of Upstart, and acting as a middleman would make it more efficient and as a revenue collector, and they wouldn't have to invest too heavily into updating their algorithms because the data would automatically make their models more and more efficient over time. So the growth catalysts. So the first growth catalyst was the auto loan originations that will boost Upstart's revenue in the next couple of years. There are three other factors that are working in favor of the company. First, if banks are likely to identify Upstart as a reliable middleman in the future, which would likely lead to a reduction in the cost of funding. Even in the second quarter, partnering banks were willing to offer loans at a reduced rate to Upstart customers as the credibility of the platform continued to increase. The company uses an AI algorithm to approve or decline loan requests, and more than 70% of loan originations in quarter two were fully automated. And because of this, it has a very reliable middleman, and we will see more and more banks moving towards Upstart or using Upstart as a service in the future. The second, the growth in the popularity of Fintech will help Upstart attract many new customers to its platform, leading to an expansion in valuation multiples as well. Historically, there has been a noticeable disconnect between technology and finance, but things are certainly changing for the better. Many Fintech companies have emerged as big winners over the past couple of years, solving day-to-day problems faced by consumers, and big banks have finally accepted the need for serious changes to compete with the growing popularity of Fintech. So the next thing we're going to be looking at is the Upstart quarter two earnings of August 10th, 2021. So this is a disclaimer. We'll skip to the actual information here. So Upstart as a glance. So Upstart is an AI lending platform that partners with banks to improve affordable access to affordable credit. It's a leading AI lending platform with scale, rapid growth, and profits. It's a two-sided business. It connects consumers to AI-enabled bank partners. Its growth is driven by the conceptual improvement of its AI models. 71% of loans were instantly approved and fully automated, which wouldn't be at a very high cost to the company. And 97% of revenue were fees from banks or servicing with no credit exposure. And its GAAP net income finally became profitable. However, their GAAP net income has been profitable since last year as well. So their value propositions to consumers and bank partners: they have higher approval rates, 71% as previously mentioned are instantly approved, and they're more inclusive, improved credit access for all demographics tested. So these are the benefits to consumers. For banks, the benefit is highly automated, all digital experience, customizable to the bank's credit policies and risk-taking ability, and it's more inclusive and profitable lending programs as well. So the large growing market that Upstart will try to move into in the future. So Upstart started off with its personal loan originations, which is an $84 billion market in the US. And now it has been slowly expanding into auto loan originations in 47 states, which is $635 billion market. And in the future, they're looking to, I think they're starting to expand, but they haven't fully done it yet. They're looking to or starting to expand into US consumer credit, which is a massive $4.2 trillion market. Even if they take like 20% or even if they take like 10 to 20%, you're still looking at a significant market opportunity. And once they do get a foothold, due to the number of customers and the number of people and data points they will be able to plug into their AI models, it will become more and more efficient in the future. So its auto opportunity update. So it's expanded its auto refinance from 33 to 47 states, which is more than 95% of the US population now covered. It secured dealership footprint by it's increased its dealership footprint by 24% sequentially in quarter two of 2021 and doubling year to date. Over $1 billion in vehicles have been sold through their Prodigy platform in quarter two of 2021, and 5 bank partners have signed up for the auto lending as one of Upstart's customers. So in quarter 2 of 2021, some of their key financial highlights. Revenue was up 194 million, which was up 1,000% year over year. Its income from operations was 36 million, up from 11.4 million in quarter 2 of 2020. Its contribution profit was up 96.7 million, which is up more than 2,000% year over year, and represents close to 52% of the fee revenue that they have. Their net income is 37 million, up from 6.2 million in quarter 2 of 2020. And its adjusted earnings before interest, tax, etc. is close to 60 million, or 31% of revenue, and it's up more than 4,865 BPS year over year there as well. So this is just the data that they just showed us, but we can see their earnings per share is now 39. Their diluted earnings per share is now 39 cents. Their adjusted net income per share is 62 cents. Their net income is $37 per share. $37 million, I'm pretty sure. And their adjusted net income is close to 60. So overall, we can see that as a whole, compared to quarter 2 of 2020, we've had revenue up more than 1,000%, revenue from fees up more than 1,300%, contribution profit up more than 2,000%, and operating expenses also up 500% year over year. So overall, 2020 to 2021 was a very good year for Upstart. They got very good data and improving their models through their personal loans and auto loans as well. So overall, I believe this company looks quite promising. It has pretty good growth over the last year. The last thing we're going to be doing is looking at a little bit of technical analysis. The stock hasn't been here for long, so there isn't much to look at, but you can see there's a very clear uptrend. The stock just basically surged from about its 20-day simple moving average way higher. We're looking at maybe $80 up in the last month. So the stock has had a massive growth surge over the last while. I believe currently the stock price is too expensive. I wouldn't personally enter the market at $220 per share. However, I do believe the growth is really good. But if we look at the minimal data that we have over the last year, anytime the stock has hit a new high, the market has corrected itself. So we looked at reaching $100, it fell back down to about $50. Then we're looking at $150, it fell back down to about $90. Then we went all the way up to about $170, $180, and then it fell back down to $111, and currently it's at $220. So based on recent trends, I would see the stock fall down maybe to a bit of $160, $170 at best. But even if it falls down close to $180, $190, that would be a much better time to enter the market. If I remember previously correctly, 7 analysts did analyze this company and this stock, and they had an average entry price of close to $179. So I would wait a while until this stock goes down, but overall I do believe this stock is very promising. It had a very good 2020. It has the potential to disrupt the market with its AI modeling and machine learning. So in the end, it's always your choice. Make sure to do your own due diligence, and I hope you enjoyed this video. If you did, do make sure to subscribe if you made it this far, and like the video if you did as well. Thanks for watching, and I'll see you in the next video. Bye.